Love it.
But if we lead them where we want to take them, that's manipulation.
Yep.
We don't want to do that.
Yep.
That's not a good move.
I love it. Just out of curiosity, you said you changed the name, but this is a real scenario. Is what you're going to go through next an actual thing that you presented?
Yes.
Okay, great. All right, let's dive in.
Okay, so they want to know about life insurance. You've asked about life insurance, so I'm going to go to a life insurance illustration.
Which our YouTube community thanks you. So our viewers like seeing these.
Okay, good. Well, I'm going to probably do this different than most people.
It's great. Better.
I've been doing this a long time, and I've learned that there's some things that are real important. Number one, you got to know how do these policies work and what does it mean.
Are you able to zoom in slightly more?
Mm-hmm.
If not, that's okay.
In fact, as we get a little further into this illustration, I'll get real, now it's zoomed out, but I will get very detailed on where we're at. So this is Richie Rich. That's the name change. And I said Perma-Rich because we're looking at a permanent policy here. And this happens to be with Penn Mutual. I'm going to first say that all whole life policies, basic chassis works the same. And from my experience of 40 years, the company that says they're number one and the one that's number 30, there's probably a 1/4 point difference in their returns on cash value and their death benefit. They may throw more bells and whistles in. There may be more flexibilities in one company than another. There may be certain years where a number looks a little different, but they all work exactly the same. They're by contract. Whole life insurance is the oldest form of life insurance there is. So I don't get my opinion involved in this at all. Okay. So I only want to deal with the facts. So here's a few facts. This person we found out had a good top rating, Preferred Plus, non-tobacco, and we're looking at a $1 million face amount. There we go. $1 million face amount of this policy. We also added 2 things. One was called disability waiver of premium. And that's a contractual guarantee that if they are disabled for 6 months or longer prior to age 60, that Penn Mutual in this case will pay the premiums remaining until a paid up policy of beyond age 60 can be achieved as if you paid for it. And there's different definitions on whether it's own occupation and for how long and those things. But none of their investment accounts have that. None of their savings accounts have that.
Yeah, it's unbelievable. If something happens to you, they're going to fund this policy till a certain 65.
If your 401k administrator came to you or your bank and said, hey, we like you so much and we appreciate the money you're putting into our bank, into our investment, and if you can't do it because you're disabled and can't work, we're going to take over this for you, but you get to keep all the privileges and benefits.
Yeah.
There would be lines around the banks for miles for people to come get that. Insurance companies are the only one that do that. And not all insurance companies and not on all products, but on this type of product they do. The other thing that we added is how we're using the dividends. That's a non-guaranteed portion of this policy. So I want to do 2 things. I'm going to ask you to help me with a little math in just a second, okay?
Uh-oh. Okay.
It'll be easy math. And I know you can do hard math too. So what we want to first look at is what is the cost of this policy? How does it operate? What do you get when you do this? So and this is all built just on the basis part. There's no
PUAs.
No upfront PUAs. And I show everybody this first.
Yep.
Where they end up is based on what it is they want to accomplish. And I don't care.
Yep.
By the way, I got to restate, I'm not an insurance agent selling policies to people any longer, but I've done it for 37 years now where I've worked with clients. I sold for years and years and years. Now I help other people know how to do this. I can still do the meetings with the client, with the advisor. I do a lot of those every week. And this is exactly how I talk to the consumer, the client. When you buy a whole life policy, there's 3 things that are guaranteed. There is a guaranteed fixed premium. And in this example, for a 35-year-old Preferred Plus, the premium is $14,162 annually for the $1 million initial face amount. Now you can pay premiums monthly. And if you do, the total annual premium will be a little more because there's an internal finance charge to do that because they're loaning you the money up front to pay the premium while you pay it monthly. So they would be a little internal charge. That impacts cash value just a little. So paying an annual premium is typically better if you can do it. The downside to having them pay an annual premium is when the premiums due, they have to sometimes think about, why am I doing this again? This is a big check. I've written checks for over $1 million into premiums over my lifetime. And even knowing why I do those things and excited about it, I would sometimes say, no, that's a big check. I got to really think about this. So knowing the purposes is real important.